Good morning, everyone. This morning, I'm going to give you an overview of the Nedgroup Flexible Income Fund and take you through some what's happened. I just want to quickly check if you can see there on the slides. On slide 2, we thought we'd give you a quick performance overview of the last couple of years. We haven't done that in quite a while. As you can see here, we've got in your column on the right-hand side, that would be, our benchmark, which is not too dissimilar to, what we see on for money market funds. And if you look at in the middle column, you can see the Nedgroup Flexible Income Fund, the performance over multiple years, 1, 3, 5, and 7. Now, what we try and achieve with this fund, which is, as you know, a diversified income fund, is to give clients, consistent outperformance of typical money market funds. And ideally, we aim for outperformance of 1 to 2%, over a medium time horizon. And it's been pleasing, as you can see, over multiple periods, we've been able to deliver that performance to clients. Obviously, outperforming money market funds does not come with a bit of risk. Our job is then to make sure that we, make that return experience as consistent as possible for clients and to limit, any drawdowns. So, I think it's a fantastic time to be an income investor, and I'm going to take you through, what we've seen the last couple of months and our view going forward. Just a quick overview of what happened last year and the quarter. As you know, it's been a quarter of many ups and downs with just look at the All Bond Index. The All Bond Index, the month of May, was the third worst monthly performance in 20 years. So that just gives you an idea what we've experienced. The All Bond Index ended up losing 1.5% over the quarter. If you look at then, I rather focus maybe on longer term numbers. The 1 year number, you can see the gross of fees, the fund returned 9.8%. What is quite pleasing, if you look at where those returns came from, they came from offshore returns, floating rate notes, and nominal bonds. And that speaks to our approach of having a diversified alpha approach, where we source returns from multiple income asset classes. So again, I think quite a pleasing number. We will speak to the current fund setup and what we see going forward. But to summarize, I think it's been quite a decent year. But as I always say, in investing, the challenge is always forward-looking. What we're going to do now is give you a bit of an overview of kind of more some of the factors driving returns. And we're going to start off with, you saw the title of the presentation, Are We there yet? And I think this refers typically to, if you look at inflation, yes, inflation has peaked. So definitely we're there yet, and we're on the road to lower inflation globally and locally. But if you look at rates, interest rates, the Fed has hiked, just about 5% in rates in a short space of time. So, obviously that's got a lagged effect on the real economy. If you look at the FOMC dot plot, you can see there at the end of 2023, the members are seeing rates, kind of closer to 6%. So we are expecting another 2 hikes, 2 25-point hikes by year end. The Fed is meeting today, and it's widely, or it's expected that there will be a 25-point hike. What is interesting though, if you look at the end of 2024, the average expectation is for rates to be at above 4.5%. And I think this is the message, and what the market has been grappling with is that the market is looking for rate cuts a lot sooner. There is talk of a recession, but it's been quite clear from the Fed that they want to make sure inflation comes in lower, and they are definitely focused on bringing inflation to that closer to that 2%. So for them, it's rates higher for longer. The market doesn't always agree, and the market's been looking for some sort of Fed pivot. I think in all of this, in monetary policy, what we've seen, it's important to note that there's obviously a lagged effect, and we haven't seen, all these effects on balance sheets and consumers play out just yet. If we're looking at this inflation picture in the US, you can see the headline inflation, that's now closer to 3%, and core inflation is still quite sticky. The big issue in core inflation there would be the shelter component, where that has been quite sticky, and also, unfortunately, a lagging indicator. If you look on the right-hand side, US rent prices, that is more a current view on the shelter component. And you can see there how that's come down quite sharply. So we would expect that US core inflation should be heading down, but kind of an opposing effect would be base effects, where we've had big inflation numbers falling out of the numbers. So there's been a big base effect in this lower inflation. That is waned quite a bit now, and we should see inflation coming in a little bit stickier in the next couple of months. So, but all in all, I think the Fed should look at this and think, that's quite a decent picture. But we're not out of the woods yet. What I'm going to show you now is quite a busy slide, and we'll take a minute or two to explore this, because this is quite interesting. This is a slide where you can see the shaded area would be the debt to GDP of the US, and you can see the inflation in kind of on my side, it looks like a light green, and then rates kind of a light blue. Now, if you cast your eye there and you go back, this data goes back back to the 1940s. You can see there how we had big fiscal deficits in just post and during the Second World War, and this created a lot of inflation. You can see there that rates was quite low, and they didn't manage to rein in inflation because of these big fiscal deficits. Now, if we move into the 70s, you can see there a lot lower debt to GDP, lot lower fiscal stimulus, and this is where monetary policy was quite effective. You can see rates there, quite effective in bringing down inflation. So when you don't have, and I think the message is here, when you don't have fiscal dominance, where you basically monetize, fiscal debt, and that goes into inflation. If you do not have that, monetary policy is quite an effective tool to control inflation. Now, if you fast forward to where we now, you can see high debt to GDP, big fiscal deficits, that obviously this monetization led to inflation. Currently, monetary policy is trying to do its utmost to rein in inflation. But as an opposing effect, you've got these big fiscal deficits and a loose fiscal policy in the States. I mean, I think their current fiscal deficit is around about 8%, where you've got inflation, where you've got unemployment around about 4, just below 4, which is kind of unheard of. I think the message here, what we want to leave you with, is that it could be you've got these two opposing forces, and that monetary policy is actually quite ineffective, or not ineffective, but that transfer mechanism doesn't have a high beta compared to maybe the 70s. So, that speaks to the camp of soft landing. There's lots of people, you've got people saying there should be a recession, people saying a soft landing. This speaks to, I think, the camp of definitely of a soft landing. Maybe I'll just quickly go back in the last message here. The other thing to take from, if you look at the makeup of the US economy, would be that a large percentage of mortgages are fixed. So that's another factor that makes monetary policy a little more ineffective, because of the large percentage of fixed rate mortgages. So I think it's quite balanced at this point in time, and I think what we've just mentioned, a couple of factors which might actually support the Fed in saying, listen, rates might actually be higher for longer, because from this point forward, inflation might be a little bit stickier than expected. If we move on to local rates, local rates, as you know, is now at 8.25. What I'm showing you here, if you can look at the left-hand side, we calculate US yields, South African yields, comprising of quite a few factors, and we can then calculate the implied risk premium. You can see that in May, that implied risk premium went up to 5%. The two graphs there, one assumes a 5% long-term inflation, the other one 5.5. we see the fair value of the risk premium closer to 4%. You can see how that's trended down, and SA bonds, has actually come down about 1% in yield over the last month or two. So at least some of the mayhem we saw in May has actually come back a little bit, which has been good for income investors. The other side to this is, if you look on the right-hand side, the US real yields, that has gone up. And that's a component of how we calculate SA rates, bond yield fair values. We believe US real yields are on the cheaper side. And the takeaway is, we believe on a relative basis, SA bonds are closer to fair value, but global and local fixed income are cheap, given higher real rates. Higher rates might be a little bit longer with us, but if you look at the big fiscal deficits, it's difficult to have high real rates when you've got these large, big fiscal deficits. Then if we move on to just the rand, not too long ago, we were closer to 20. What a difference a couple of weeks or a month or so makes. We are now comfortably below 18, so what a pleasure. What we've done here is just calculate the rand from a purely theoretical point of view, purchasing power parity. And you can see there typically the rand trades fairly cheaply over time. We've done no fundamental adjustments. But what we see here, the rand is cheap. Our fair value, and we don't believe in pinpoint estimates. I think it's probably between 16 and 17 rand to the dollar. But I think in the current environment with tightening global credit conditions, you might see the rand maybe being a little bit weaker for longer. But it definitely surprised. I think it was definitely oversold if you look at especially in May. So, long may it last. If we then move on to local rates, we had a pause by the SARB. I think the market was expecting, 225-point hikes or another 50 points. I think we now, you go back to the title of the slide, are we there yet? I think we are close. And it could be that we've seen the last rate hike locally. It could be that there's probably another 25 points for the SARB to go. I think what we believe is ultimately, inflation. If you look at inflation on the right-hand chart, inflation is not an issue. Inflation is back into the target band. Headline inflation 5.4, core inflation 5. I think the reason why the SARB actually hiked, quite aggressively in the last meeting was more about the rand and securing capital flows, with a backdrop of tightening global credit conditions than inflation. So I think the rand has become more of an issue, I believe, than actual inflation. So I think we're just about there yet in terms of a peak in rates, and that typically bodes well for nominal bonds and duration assets. But we're not out of the woods yet. We will see, how especially the US and Europe responds to this tightening and the lagged effect. If we go to the fund, a quick overview of the fund. Ultimately on the fund, we focus on diversification. We believe that we can protect clients against some drawdowns by trying to source income from different asset classes. We maintain a high degree of quality. Bonds are a bit closer to fair value. We remain nimble. In May, we added duration to the fund, which turned out to be, I think, quite a good buying opportunity. If you look at the fund at the moment, our 12-month yield is closer to 10%. Our total duration is about 1.4, which is made up by nominal bonds at about a duration of 1, inflation-linked bonds 0.2, and offshore duration of 0.2. Global fixed income has become investable at long last. We like what we see, in the global front. Our global components got a yield of closer to 6%. Our offshore exposure, we've brought back a bit. That's about 3.3 at the moment. And if you look at that asset allocation there on your right-hand side, I think the big thing there is you look at floating rate notes, a big income underpin for the fund, where we try and outperform money market by at least 1.5 to 2% over time. So for us, the job stays to provide clients with a high degree of income, while having a keen eye on on the risks that to take. And consistency is key for us in this fund. Thank you.